Hey guys, welcome back. You're still tuned into Trading Hour. For the market, we're seeing a 125-point gain, so there's been no let up at all over there. 21,385 is where we're at on the index right now, and the mid-cap, small-cap seeing a full 1% in terms of a gain. Let's invite Pawan Parakh from Renaissance Investment Managers to join us now on the show. Pawan, it's always great to have you on. Thanks for joining us, and season's greetings to you and your entire family and team as well. For the markets, we have seen, of course, after hitting those record high levels, we have been pretty much trading in a band for for the past few days as well. Do you think that is how the theme is going to be for the coming few weeks, where it could be a little bit slow, could be range bound, and we'll just consolidate at these levels? Pawan, I think you're on mute there.
Sorry. So season greetings to you and your team as well, and thanks for having me here. Coming to markets, I think the year that went by was a phenomenal year as far as mid-cap, small-cap were concerned. Something like 35-40% return at the index level. Safe to presume such numbers, such growth cannot continue going ahead. But at the same time, I want to believe that over the last 2 years, there's been a massive sideways movement as far as Nifty index or large cap index is concerned. And you see some of the large cap weights on the index, be it banks, IT companies, Reliance, all of them put together is something like 60% of the Nifty index. And these stocks haven't gone anywhere. I would want to believe that for the near future, large caps should do better than mid cap, small caps. And a lot of these stocks, especially something like banking sector, which haven't performed for quite some time, should do well going ahead, say maybe in the next 6-9 months.
Okay, Pawan, hi, good afternoon, and thanks for joining in. The entire consumption space is doing very well, right? Whether it's the platform companies like Zomato, whether it's the beverage companies like Varun Beverages, all of these stocks have been big movers this year. Do you expect this trend to continue, or are you concerned now about valuations for some of them?
Yeah, actually, consumer pack, if you see, has been a pretty tricky pack because, if you see some of the categories, as you said, is doing well. Jewelry is doing well, travel is doing well, but on the other hand, if you see a lot of these other categories, be it apparels or footwears or maybe consumer durables, they are absolutely, there's a serious lack of demand as far as our channel check suggests. And I guess my understanding is that post-COVID income levels have been disrupted and people are prioritizing their spends at different points in time. So as things stand today, sectors which are doing good, maybe tech companies is something that we like, but otherwise some of the staple names or maybe names which are banking on rural recovery, their valuations are a little bit of a concern. On the other hand, where there's where valuations are fine, their earnings growth is a concern. So for us, consumer is a pretty tricky pack, and we are cherry picking stocks that we want to own in this sector.
Okay, that is the word that we've been getting from all of the managements as well that we've been speaking to. Pawan, you mentioned the tech space. Tell me what you like within that. And also, what is your thought on some of these new age tech companies? For example, something like a Zomato has done so well this year. The financials also looking a lot better, even for names like Paytm. So how do you look at these, and do you think that it makes sense to get in now?
Yeah, it really makes sense. So essentially, from our point of view, what we are looking at is that industries, tech companies which operate in sectors which have got a very huge, long growth runway, and more importantly, spaces where consolidation has happened. So maybe fintech is one space, Paytm wherein operates. I don't think there is a space for a fourth or a fifth player. Similar is the case with Zomato, Swiggy. There is hardly any chance for a third or a fourth player. So in tech, we are essentially liking sectors wherein, consolidation has happened and still the growth runway is very huge, which essentially means as growth comes by, profit pool is going to become very big and there will be only 2 or 3 players who will share the entire profit pool. And more important to understand, these companies will benefit from operating leverage and incremental capex or incremental spends are going to be less, so which means that there will be a significant amount of cash flows. So this is where we are picking our bets. We are not banking on the entire tech sectors. We are cherry picking stocks, essentially stocks wherein consolidation happened, and these players have built some very strong entry barriers for a third or fourth players to come in.
Okay, got it. The other space I wanted to ask you about was defense, because that's the big area for the government, right, in terms of spending. And even as we speak, despite the rally that we've already seen, stocks like, say, a BEML or a couple of the other defense companies, HAL, continue to hit new highs. BEML, for example, has almost doubled this year now and is almost at 3,000 rupees. Is it, have people missed the bus here, or could there be more to go?
Well, given the rally, a large part of the gain is done, but I still don't want to lose hope. It's a 15-20 CAGR story from here on. Very clearly, India is a large importer of defense products. I think this is one sector wherein Make in India, government has been spot on. There have been at different points in time, total, I think 5 or 6 lists where government has released wherein they don't want to import all the products that are mentioned in that list. So very clearly, defense is a key priority area for the government. And here, I think after a long time, we've got our execution right. You would see yesterday, Bharat Electronics upgraded its order flow guidance. I would want to believe that order inflow or maybe upgrade cycle for the defense sector will continue for next 2-3 years. But I would also mention that, 3 years back, until this Russia-Ukraine war broke out, this was not an easy ESG compliant sector. And at that point in time, the valuations were way too low. Now, significant valuation re-rating has happened. And now, if you see earnings growth is something like 15-20%, and that is what you should expect from these stocks in this sector now.
Okay, that is on defense. Pawan, another space where you are seeing a lot of this, a lot of stock movement is this entire railways pack, the other PSU stocks as well, right? Power. Do you think over there as well a bunch of the up move is done? Because, even after the run-up, some of the PSUs, if you just look at the valuations, are still not too bad.
Yeah, no, I agree with you. Power looks very interesting to us. We continue to own stocks which are directly or indirectly related to power. So we own power financiers, we own some APC or maybe capital good industrial companies, which are a great play on power sector. And we also own utilities there. So power sector, I think nothing's missed. I think there's substantial amount of money to be made in power sector even now. But on the other hand, railways, I think we are a little cautious because we're not really very comfortable with the companies which are a play on railway sector. They don't have a really great track record of cash flows, ROE, or great managements which you can bank on. And typically, all of them are mid-cap, small-cap names. So if things go wrong, you don't get an exit. So railway is something we are by the sides, but power is something that we are really excited about, and we are playing this entire sector through multiple ways.
Okay, all right. Pawan, just one final question overall on the market. It's been a very strong run, but we had some signs of a reality check, on Wednesday when you had that shakeout. Are you concerned? Are there any concerns on the horizon at the moment in the market? And if yes, what are the risk factors that investors should look at?
No, I think very clearly for the markets, geopolitics is the biggest risk. But having said that, other things remaining constant, I think there is no doubt, at least in my mind, that we are in a very big bull market from here on. If you look at the political scenario, economic scenario, domestic, globally, things look pretty sanguine. But having said that, I would also like to mention, if you go back into the 2003 to 2007 cycle, there was at least 4 to 5 times when market corrected by something like 10%. So even in bull market, you have corrections and you have sideways movement. We can have something of that sort going ahead because as we just discussed, last year, as far as mid-cap, small-cap is concerned, at the index level, you've seen something like 35-40% appreciation. At the stock level, there have been stocks which have been 3, 4, 5 baggers. So typically, you could have a bull market corrections, but directionally, 3, 4, 5-year view, I think one should be very positive on markets.
Okay, very positive on markets from a slightly longer period. Pawan, it's a pleasure having you on the show. Thank you for joining us and taking us through that quick call in the market and some of these individual pockets as well. With that, we're going to wind down on this edition of Trading Hour with the news that the market has held very steady over the last 1 hour that we have been speaking, 120 points higher over there. The mid-caps, there's no let-up there as well, still trading with an over 400-point kind of gain. From Sonia, me and the entire team, thank you very much for tuning in. We have halftime report up in 2.
CNBC-TV18, embarking on a quarter-century of...
Thank you for watching CNBC-TV18. For all the latest news and updates, do follow us on our social media platforms.